Hello everyone, welcome. I'm so glad you're here. If you're watching this, you're thinking about your future, about moving beyond just earning a paycheck to start building genuine, lasting wealth. The path can feel confusing, filled with jargon and conflicting advice. My mission today is to cut through that noise and give you a clear, simple starting point. Today, we're diving deep into a classic investing showdown, VOO versus VTI. These are two of the most popular exchange-traded funds, or ETFs, on the planet, from the trusted company Vanguard. They are the go-to choice for millions. The big question is always, which one is better? Which one will ultimately make you more money? We're going to find out. You work hard for every dollar. But what if each of those dollars could start its own career, working for you around the clock? That's the core promise of investing. It's about making your money work as hard for you as you worked for it, creating a real path to financial freedom. This is how you build real wealth. It's not about timing the market or finding a secret stock. It's about simple, steady investing. Think of it like planting a financial seed. With consistency and time, it grows into something substantial, all thanks to the incredible power of compounding. I know that putting your money into the stock market can feel scary. We hear stories of volatility and risk, but it doesn't have to be that way. For most people, especially those just starting out, ETFs are the single best and easiest place to start. They were designed to take the guesswork out of investing. Think of ETFs as your ticket to the market, a ready-made basket of companies. Instead of trying to research and pick individual winners, you can buy a small piece of hundreds or even thousands of companies in one go. This gives you instant diversification, the most powerful tool for managing investment risk. So with thousands of options available, many of you ask, where should I start? That conversation almost always leads to the two giants we're discussing today. It's the ultimate face-off for new investors looking for a solid foundation. Which one wins, VOO or VTI? Today we break it down. We'll look under the hood at their holdings, compare their historical performance, and examine the crucial tiny fees that impact your growth. We'll analyze their risk and, most importantly, define who each fund fits best. Stick around. By the end, this won't be a question for you anymore. I'll give you a clear framework so you can confidently choose the right fund based on what truly matters to you and your financial future. Let's get started. First, VOO. That's the Vanguard S&P 500 ETF. Ticker VOO. VOO tracks the S&P 500, roughly the 500 largest U.S. companies. Think Apple, Microsoft, Amazon, Google. It's blue-chip, large-cap exposure across every major sector. VOO gives you about 80% of U.S. market value in a single fund. If you want the big names and a smoother ride, VOO is built for that. It's the all-star team of American business. Powerful, focused, and simple. All right, if VOO is the star quarterback, think of VTI as the entire team. Let's introduce the Vanguard Total Stock Market ETF, or VTI. This fund takes a fundamentally different and much broader approach to investing in the American economy. It's designed to be the ultimate set-it-and-forget-it fund for those who believe in the long-term growth of the entire U.S. market, not just its biggest players. And that word total isn't just marketing fluff. It's the core of its investment philosophy. The idea is simple but powerful. Instead of trying to pick the winners, why not just own the entire field? This strategy aims to capture the performance of the whole U.S. stock market, leaving no stone unturned. So, what does the entire field look like? VTI holds shares in nearly 4,000 U.S. companies. That includes the large-cap giants you know and love, but it also includes thousands of mid-cap and small-cap companies. This means you own a piece of Apple and Microsoft, but also a tiny slice of a regional bank, a promising biotech firm, or a small manufacturing company. They're all in there. To put it another way, if the U.S. stock market is a giant pizza, VOO gives you a huge, delicious slice made up of the 500 most popular toppings. But VTI gives you you get that main slice, but you also get the crust and all the other smaller, unique toppings. You're betting on the success of the entire pizza. And why would you want those smaller pieces? Because while large companies are stable, small and mid-sized companies often have more room for explosive growth. A small company that develops a groundbreaking product can see its value multiply. VTI is structured to capture that upside potential. When one of those smaller companies takes off, you're already on board. So, VTI is perfect for the investor who wants the ultimate diversification. It's for someone who says, I believe in American innovation as a whole, and I don't want to miss out on any part of it. You're not trying to beat the market, you're trying to the market. It's a powerful, simple strategy for long-term wealth building with absolutely no FOMO, fear of missing out. Both are diversified, but the degree differs. Diversification reduces risk. It's the most important rule. VOO spreads risk across 500 of the biggest companies. VTI spreads across the full-size spectrum, almost 4,000 names. Here's the twist. The top 500 still make up roughly 85% of VTI's value. In practice, that means day-to-day performance looks almost identical. The tail rarely wags the dog. Quick warning, past performance isn't a guarantee, but history is useful. Look at long-term charts. VOO and VTI move together, almost mirror images. Annual returns often differ by mere hundredths of a percent. Some years VTI edges out VOO, some years VOO leads, it flips. Over decades, those tiny differences wash out. Bottom line, performance is practically a statistical tie. Choose on philosophy, not on tiny edge. Fees eat returns, but Vanguard shines here. As of today, both funds charge about 0.03% expense ratio. That's roughly $3 per 10,000 invested. Practically free. On fees, it's a dead heat. Both are champions of low-cost investing. Risk, both are stock funds. Market downturns hit both. Theoretically, VTI is slightly riskier because of small caps, but in practice, the difference is minimal. Who should pick VOO? The simplicity lover. If you want to own the companies you know and trust, VOO fits. It's the low-cost S&P 500 approach championed by Buffett for most investors. If you want clarity and comfort, VOO helps you sleep at night. New investor? VOO is an outstanding, no-nonsense first fund. Efficiently captures the heart of the U.S. market. Big names, big stability. So who is VTI built for? It's for the ultimate market purist, the investor who believes the best way to capture the U.S. economy's full potential is to own a piece of every publicly traded company. It's a philosophy rooted in the idea that you don't need to pick winners when you can simply own the entire playing field. While an S&P 500 fund holds 500 large companies, VTI takes it a giant leap further, holding thousands of stocks. It includes big firms, mid-sized firms, and even small emerging companies. By tracking a total market index, it provides a comprehensive snapshot of American business. It is market cap weighted, so giants like Apple still have the biggest influence, but those smaller companies are in there, offering broader diversification. And that's a crucial difference. History shows there are distinct periods where smaller, more nimble companies outperform the established giants. By owning VTI, you have a built-in ticket to that potential upside. You're automatically positioned to capture growth wherever it appears in the market. This makes VTI the quintessential choice for the true set-it-and-forget-it investor. There's no need to buy separate funds for different market segments and worry about rebalancing. VTI does all that work for you, embodying the ultimate simplicity in passive investing. Ultimately, the choice is less about chasing different returns. Their performance is historically over 99% correlated, and more about your investment philosophy. Do you want to bet on the established champions or the entire American enterprise, from the titans down to the next game changer? With VTI, you're investing in the whole story. So, VOO =, all stars. VTI =, the whole league. Performance, fees, risk, almost identical in practice. The real secret is simple. Pick a strategy you believe in, fund it monthly, and leave it alone. Do that, and the market's compounding will work for you. If this helped, hit subscribe, leave a comment. Tell me which you prefer and why. Thanks for watching. Be consistent, stay patient, and happy investing.